Hello, everyone, and welcome to our webinar. My name is Saar Menachemi, and I head up DealCloud's marketing and business development efforts. Today, we will share the results of the Fall 2020 Dealmaker Pulse Survey, along with data-driven takeaways specifically for private equity firms and fund managers, investment bankers and advisory firms, as well as for credit firms and leveraged finance professionals. Before we begin, we wanted to take a moment to review a few housekeeping items. We, the DealCloud team, and myself included, are currently working from home, in my case, in Queens, New York. So there may be an occasional background noise like a siren that we hope you excuse. As Zoom experiences high usage volume, we may experience connectivity issues or slowness. And while unlikely, it's worth mentioning that if we or you have any issues, this session is being recorded and will be sent to all after the webinar is finished. Lastly, participants can submit questions during the webinar via the Q&A function. We will answer questions at the end of the presentation. With that said, let's get started. For those of you I haven't had a chance to meet, I joined DealCloud almost 4 years ago, and it coincided with the current version of our platform being released. I joined DealCloud with a long history of working with private equity firms, investment banks, lenders of all types, and M&A professionals throughout my career. Before joining DealCloud, I spent many years at iLevel and subsequently iPrio's private capital markets group. And before that, I spent many years at Intralinks as well, working with both the buy and sell sides. I'm excited to share the results of what we gathered. But first, I thought it would be helpful to give a little background on how we conducted the survey itself and ultimately how we were able to crunch the numbers that we did. In April of this year, we issued our inaugural DealCloud Dealmaker Pulse Survey so that we could learn more about the trends and issues affecting professionals in the capital markets industry, especially since much of April and March were really uncharted territory for most of us. We asked a handful of questions. Okay, maybe a little more than 2 handfuls, or in this case, a baker's dozen of questions of professionals at private equity firms and fund managers, and bring you the results of our second survey of 2020, which is flush with new data showing how the broader market has been affected by current trends. The survey was conducted just a short time ago in October, and all responses are anonymous. For those not familiar with our technology, DealCloud offers a deal relationship and firm management platform. And like our nearly 1,000 clients, we use our own technology to power our internal operations. We drink our own champagne, so to speak. Part of that is using our marketing technology solution, Dispatch, which is also leveraged by 150 firms today. Specifically for this survey, we use Dispatch to create the survey's webpage, to distribute emails asking private equity professionals to participate, and to collect the anonymous results. If you have questions about Dispatch or the DealCloud platform, be sure to visit www.dealcloud.com. You can click Request a Demo, and our team would be happy to show you how our technology can help power your process as well. Starting at the top, we thought we would spend a few minutes talking about the firms and respondents themselves for the survey. As mentioned previously, we surveyed fund managers, the vast majority of which were either private equity buyout funds or had growth equity strategies. And we are thankful to all those that responded and provided insights for this survey. Responses came in from both DealCloud clients and non-DealCloud clients. As you can see on the slide, many of the responses are from investment professionals. but we also have representation from investor relations, IT, operations, and finance. A large number identified themselves as either members of their firm's executive committee or who were partners or MDs. In fact, 69% of the responses came from senior people at their firm if you look at everyone who identified above the VP level. We also saw a fair spread of firms of all sizes, ranging from boutiques, many with less than 10 professionals, to larger firms with over 100 professionals, and truly firms of all shapes and sizes in between. We feel that all firms are represented fairly well in these results. So let's dive into the findings. The first question we asked was, what is the primary focus of your firm, specifically over the next 6 months? Since this is the second issuing of our Dealmaker Pulse survey, we are able to compare answers side by side. And the results are heavily focused on acquiring new companies. When coupled with rolling up or bolting on companies, 79% of respondents are primarily focused on acquisitions, which is a large increase from April, when only 52% of firms felt this way. What we believe this means for private equity firms and strategic acquirers is that, and probably no surprise, there are many firms out there who are looking to be acquisitive, driving competition up. This also means that now is the time to double down on business development efforts if you fall into this category of nearly 80% of responses who are looking to acquire new companies. What's also clear in this answer is that people are looking for new platform companies, not just add-ons. For our investment bankers, intermediaries, and lenders on the call, this means that there are a lot of firms to cover and possibly buyers that you are missing out on. Regardless of what role you play on a transaction, the need to cover the market, tracking, reporting, and analysis of buyers and sellers is more important than ever. Notable here as well is that the response around mitigating the effects of COVID-19 has fallen significantly, and we view this as a very positive trend. The big shift in focus to new acquisitions really sets the tone for the entire report. And it will be through this lens that we'll examine almost all of the results. So, with acquisitions being top of mind, the next question we asked was, what do you believe is the biggest challenge to your firm's ability to execute on your investment strategy? And again, specifically over the next 6 months. This was the only question in the survey where respondents could give more than one answer or select all that apply. Given the increase in potential competition, the top answer, and maybe not a surprise to anyone who has underwritten a deal or valued an asset lately, is that many investors feel that irrational prices driven by increased competition is a continued challenge. This leads to a little bit of a need for a volume game for investors and sponsors. The more investable capital you have, the more you need to deploy. That leads to needing to see more assets, which leads to more deals being lost or passed on due to irrational prices or increased competition. And that dreaded cycle poses its own challenges. For example, for private equity firms, have you announced your preferences, deal sizes, and strike zone? Are you covering companies effectively? Do you have relationships with the intermediaries who are doing the deals you want to do? For investment bankers, intermediaries, and even lenders, are you tracking these buyers and tailoring buyers lists? Are you sending out tombstone emails? Do people have you on their radar? These are things that DealCloud helps with every day. Scarcity of investable assets or lack of attractive assets to buy was listed second, and coupled with high prices and high competition exacerbates the challenges here. For private equity firms, the important and reinforced takeaway here is around the importance of business development, especially when attention on supporting existing portfolio companies was third. Does it make sense to have deal teams who are working with existing companies also be responsible for sourcing transactions? Is your Monday morning meeting running as efficiently as it should be? Obviously, every situation is unique, but certainly these results open up the discussion. Sometimes supporting portfolio companies also means helping to arrange debt. And I know that many lenders, and potentially even those on the line, that specialize in sponsor-backed capital, which only speaks to the importance of coverage. The question that I would ask here is, are you, as a sponsor or lender, covering the right parts of the market to see either the deal flow or the terms that you need to see? And again, shameless plug, these are things DealCloud helps with every day. You can also see on the screen the remaining responses. Interestingly enough, unclear regulatory and tax outlook ranked low on our list of responses, which implies that while it's not out of people's mind, there are bigger challenges ahead for most firms. Since this is the second issuing of the Dealmaker Pulse Survey, we can look back and compare these results to our survey in the spring. And when we compare the two results side by side, we can see a big shift. Irrational prices and increased competition didn't crack the podium, so to speak, just 6 months ago, and now it's the most popular response. We feel that this is the true impact of the global disruption to traditional deal making that we've experienced over the last 9 months now. When most economic downturns have lowered valuations and investment multiples across nearly all industries and sectors, that just hasn't been the case here. In fact, it's been the opposite in many sectors. Just 6 months ago, securing financing or co-investment capital was the second highest perceived challenge to doing deals, and that fell to fourth in October. Attention focused on the existing portfolio remains in third, but to differentiate, we also asked about guiding companies through the recession and pandemic, and that was listed fifth this time around. So, do you agree with these results? We would love to hear your input or questions through the Q&A. Since irrational prices and competition was the #1 answer, we thought we would dive into some interesting stats we gathered around doing deals. And this was a new question we asked for the fall edition of the survey. And respondents had the ability to answer if they've done an acquisition, and if so, what kind, platform, add-on, or both. The number that surprised me the most was that 30% of firms did no deals during this time period. Given the amount of dry capital available, and if these funds are still in their investment period, this might contribute to the challenge of competition and pricing multiples when these firms come off the sidelines. And that is going to be especially true if there is a flurry of M&A activity that's being predicted should there be a tax incentive in the US to do so in early 2021. For those firms that haven't closed a deal, we feel that in addition to doubling down on business development, that it's probably also time to focus heavily on investor relations and marketing. We know that when COVID and the COVID disruption first hit in March, many investors were asking about deal flow, pipeline, and due diligence, in addition to their normal questions about returns and cash flows. You can see the relevant statistics here around acquisitions, with firms that invested in both new platforms and add-ons being the most popular answer. Interestingly enough, the majority of respondents, or 54%, had closed an add-on in the last 6 months. One of my favorite uses of DealCloud is the ability to establish an investment thesis and track all the companies that would qualify under your defined strategy, making add-ons or roll-ups so much easier. If this is something your firm is interested in, we're happy to walk you through how this works. With the increased competition and high likelihood of this continuing, we thought we would take a look at fundraising, as this is a great leading indicator for future acquisition activity as well. And the data that you see here comes from our friends at Preqin. And you can see that fundraising year-to-date 2020 is significantly off the pace of previous years. For those that are interested in data about either GPs or LPs, funds, fundraising, deals, even people, all of these are available through the DealCloud Data Cortex, as are data sets from Preqin, like you see here, but also our partners at FactSet, PitchBook, S&P Global Market Intelligence, SourceScrub, Privco, and Sutton Place Strategies. Looking at this fundraising trend, we incorporated another new question for our fall survey. And what we heard was that 18% of respondents had plans to either postpone their fundraise or raise a smaller fund. And that's seen here in the bottom two responses, the 12% who suspended or postponed, and the 6% that will raise a fund that is smaller than anticipated. To contrast this with the other end of the spectrum, slightly more than a quarter of respondents, though, are proceeding with a larger fund than anticipated. And again, potentially adding more dry capital to the pool, specifically in certain industries, geographies, or even deal types. If you take this 26% and add the additional 34% who are on track for their targeted fundraise, 60% of respondents reported that they will proceed ahead with their fund on track for its same size or larger, in what is perhaps a great sign forward for normalcy. We think it's hard to ignore the important role technology plays on managing relationships with investors and for fundraising. And I'd venture a guess that those firms that are proceeding as usual with fundraising or raising larger funds also have things like newsletters, virtual LP events, and a technology backbone that they use to help manage investor communications beyond just their traditional document portal. So we've reviewed a lot of firms are looking to be acquisitive. Many firms are still actively raising new capital, only potentially adding to the competitive environment. So what's a firm to do? We know that many firms have strong proprietary sourcing capabilities. But the importance of investment bankers, brokers, lawyers, and other channels speaks through here on this answer. We asked in both of our surveys whether respondents believe their reliance on intermediaries would increase or decrease. And we saw a 12-point increase in our most recent survey towards the reliance on intermediaries. Together with the responses on the right, we believe firms need the right coverage model and process. And that is ultimately going to drive the need for dedicated business development and capital markets roles, which is a trend we've been observing for the last 3 years. This also leads us to ask an open question to all of those on the line. What is your firm doing to maximize either your intermediary relationships or your sponsor relationships. For the intermediaries and investment bankers that we have on, how are you covering your sponsors and buyers when 93% feel that the relationship is growing in importance? We'd welcome your thoughts or questions in the Q&A, and that we'll be answering them shortly. So with all that said, what are the deals people are expecting to see? We asked, what is the primary deal source type that you expect over the next 6 months? And putting these results again, side by side, you can see the big shift in expectations. In April, corporate carve-outs and recapitalizations were the top 2 answers and have both declined significantly by October. At the time, the assumptions was that many corporations might be distressed and would look to sell assets, either to stabilize or really just to shore up their balance sheets. Founder sales this time around make up half of the responses, the largest jump by far. We feel that this response climbing so high can be attributed to both a return to quote unquote normalcy of deal doing, so to speak, and also many companies adapting and candidly some thriving post-COVID. And those companies are now looking to grow and scale and take on capital. While corporate carve-outs fell to 11%, recapitalizations fell only to 21%, which was still the second most popular answer. And we feel that we'll still see a fair number of both recapitalized equity and debt transactions in the next 6 months. It's hard to ignore the impact of COVID-19 on all of these responses. So we wanted to ask one more additional new question in this survey specifically about the return to work. We asked, does your firm have plans to resume business as usual amidst the COVID-19 pandemic? And specifically asked about returning to the office and business travel. I was most surprised by the fact that only 40% of firms had plans to resume business development travel, meaning 60% of firms do not have plans to resume business development travel. What this leads to is Zoom, like this webinar that we're hosting today, and remote diligence continuing to remain important, and that relationship building over Zoom will continue to be incredibly important. This also speaks to the importance of virtual events. We hosted our Connect conference just 2 weeks ago virtually, which is now available on demand on our website. And we've heard anecdotal stories from clients that they've made their first ever investment in a management team that they've never met in person. These trends seem to be here to stay, at least in the short to medium term. It's possible that a medical breakthrough might change these results in the future, but as of now, only a little less than half of firms have plans to return to the office, which would be an important first step. What this brings us to is the last question we asked on the survey, which was, how does your firm view technology and its impact on your firm? Over the past 6 months, a profound shift has taken place across the private and capital markets. Prior to the pandemic, select firms were successfully leveraging technology to gain a competitive edge. Today, those same technology solutions are, quite honestly, a must-have. We call this being a connected firm. Quite simply, remote work has accelerated the worldwide trend towards the connected firm, and investing and advising is honestly not immune to that. The pace we've observed is truly hard to believe sometimes. And in fact, nearly 300 new firms have selected DealCloud to power their deal and relationship management, and another 250 or so have gone live in just the last 11 months, which is well above the pace of 2019. We believe that being a connected firm has become so fundamental to how a firm operates that it's hard to fathom a scenario where firms can operate with the challenges in the market today without a fully connected technology and data ecosystem internally, and the survey results are echoing this. We thought we would wrap up with some key takeaways. We discussed many of these already, but I feel that they're worth reiterating. First, relationships matter now more than ever. The right coverage model and process with potentially dedicated professionals who focus on business development, capital markets, and even operating partners are becoming more important. The need for efficiency is increasing. This is true at all times, but mid-March was a wake-up call for many firms. And those who continue to rely on email and spreadsheets to manage operations will find it harder and harder to compete. On that front, competition is increasing rapidly. The number of buyers sitting on dry powder and firms who are successfully fundraising will have to deploy capital. And we predict that founder sales and recaps will be the most popular source of transactions. Finally, the concern regarding the health of the portfolio remains the same, while a feeling that primarily Zoom relationship building is here to stay a little while longer. DealCloud offers a deal, relationship, and firm management solution that is leveraged by nearly 1,000 firms globally. We currently support private equity firms, fund managers, and investors of all strategies, investment banks, M&A advisory firms, lenders and credit funds, and strategic acquirers of all sizes and all types to ensure the ideal outcome for their firms and their clients. We help them keep track of mission-critical processes, including their deals, relationships, and help them report on all dimensions that are critical to manage their business. For additional information on how our technology can help your firm, please visit DealCloud.com. Why don't we open it up to Q&A at this point? There should be a Q&A button there in the Zoom bar where you'll be able to ask a question, and we'll be answering them as they come in. And it looks like we have a couple of questions that have come in, so I'll answer them in the order that they came in. And the first question was, how are your investment banking clients navigating and narrowing down the huge pool of buyers? And I think this is a great question, and there's really two answers here. The first one is a little bit on the buyers themselves, sort of announcing what they're looking for. And I know that there are many successful private equity firms that send out tombstones to their mailing list, or when they raise a new fund or they make a key hire, they sort of announce that to their network, right? I would view that as almost like the bare minimum right now. In order to get on a buyer's list, you probably need to announce that you're looking to be on a buyer's list and that you have a specific, bite size, strike zone, and anything else that's relevant in that view. What I would also chime in here on is that there are lots of really helpful data sets. We talked a little bit about our partners. There are data sets that will tell you who's done a deal in the past. There are data sets that will tell you who owns a company, and that might help you find potential strategic acquirers, but also add-on acquisitions. And those same data sets can also help you narrow down, based on industry, sector, or deal type, who a potential buyer would be. And if you're not leveraging on the sponsor side that kind of announcement capability, letting sponsors know, and if you're not on both the sponsor and the intermediary side using data sets to see both who's advising on the transactions and who's buying on those transactions, I think that's what's missing in that equation. The next question we have is, on average, how many deals are PE investors looking at before they close one? This is an interesting question, and I think this is going to vary greatly from firm to firm. We don't see our clients' data, so that's an important distinction here. So, we don't have access to any confidential information on our clients, but having met with hundreds of firms over the last year, it's not rare for us to hear that it's a hundreds to one ratio, plural, hundreds to one ratio. You might see a teaser or a sim, every day of the week, and none of those would even make it to management committee. And I think that's probably something that is fairly common. So without having exact statistics there, I would say it is not uncommon for people to look at 500 deals in a year with the hopes of doing 4 or 5. The next question that came in was, if firms don't have plans to resume business development travel, how are deal makers drumming up proprietary deal flow? This is a good question as well. And I think this is the sort of world that we live in. I don't know if there's a perfect answer for that question. There are certain things that the industry has done, and the first one is shifted online. And there are still a lot of industry events that happen. There are lots of companies that still attend those events. I know that travel to conferences was historically a big proponent of many people's proprietary sourcing capabilities, and it still needs to be. And I think people still need to invest their time and effort into the virtual events. It's difficult, right? Because you're at your desk, your email is still going off, it's easy to get double booked. But I think the people who are yielding results from those virtual events are the ones that are devoting the time and effort to doing the legwork that they would have done before a real event, right? See who's attending, research who's attending, and there are data sets that you can license that will tell you who's attending big conferences, what industries and sectors are having conferences, and you can plan your virtual travel kind of that way. The next question that we got here was, other than CRM, what technologies are firms using as a bare minimum to successful operations? And I think this is another really good question, and I'll answer it in 3 swim lanes. In the front office, CRM is a must-have, and I would go as far as to say as having a data set is a must-have as well. And a data set could be about companies, it could be about peoples, it could be about deals that are happening in the market, it could be about funds and fundraising and anything else that's relevant to your investment thesis. In the middle office, more and more firms are leveraging portfolio monitoring tools, and more firms are leveraging technology to help them drive value creation in their firm as well. And in the back office, obviously accounting, or you can outsource that to an administrator, right? And I think for many years, there was a misalignment on sort of the minimum base technologies that it took to run a fund. And it used to be, well, if we just outsource to an administrator, we're just gonna do deals, and we've done deals, forever using spreadsheets and Outlook. I think to a certain extent, being able to keep up with the market and being able to keep up with the volume of the market has sort of moved past Excel and Outlook. And I would say having a data set and having a CRM for the investment teams is effectively a bare minimum at this point. And the last question that has come up is, what industries have had the most deal activity since the pandemic? That's a great question. I don't have that information readily available to hand here, but we can certainly provide that information to anyone. As I mentioned before, there's lots of different data providers that provide deals that are announced in the market. A few that come to mind are PitchBook and FactSet and Sutton Place Strategies, and many of those have those statistics around which industries and sectors have been the most active over the last few months. One more question just came in here is, what percentage of private equity firms implemented a new CRM since April 2020? That's another interesting question. And sometimes it's hard to get the denominator in that equation in order for us to get a percentage. I can tell you the raw numbers, right? Just at DealCloud alone, we've added about 300 new clients since the beginning of the calendar year. I would say probably 70% of those are private equity firms. You know, we've tried to run some statistics on that front. There are new firms that start almost every day. We get inquiries often from startup funds. We get inquiries from firms that were either not on our radar. So, you know, that number or the denominator on that number to calculate the percentage is difficult to sort of pin down sometimes. But, you know, DealCloud today works with hundreds and hundreds of private equity firms globally. And we know that we're not the only provider out there. So I would say, you know, the vast majority of firms at this point are leveraging a CRM. Those are all the questions that we've received so far. If there's any other questions, I'll leave it open for another few seconds in case one comes in here. But if not, we will wrap up. So firstly, thank you so much for joining us today. You can visit dealcloud.com/pulse to download the full report of everything that we covered on the webinar. As a reminder, this webinar was recorded and will be made available on dealcloud.com shortly. Please also visit dealcloud.com/webinars for more information on our other upcoming events, which are taking place nearly every week. Thank you again for joining us today, and please stay safe.